Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio. What I would like to do today is review the major indicator, not a long video, but the main one, and figure out if we are having a recession, a slowdown, or a deep contraction. Just an update on the latest data that have been released by the various agencies. The data in this video will tell us where we are in the business cycle. Are we in phase one? Are we in phase two when the economy grows and creates rising interest rates and inflation? Are we in phase three when inflation starts coming down, business stop making money, and consumers stop spending? Phase four when consumers stop buying until interest rates and inflation decline. Of course, all this is accompanied by a weak stock market. As I mentioned in previous presentations, we are in phase four. How far are we in phase four? Let's dig in. This chart shows the personal income after inflation and consumer spending after inflation. As you can see, has been steady at a 2%. And in fact, the economy has been growing at 2%. People talk about the consumer, people talk about income, but the data is showing that income is as steady as a rock, I guess. I don't know. It's 2% growth. So things are okay there. This chart shows retail sales and industrial production. And as you can see, retail sales after inflation, and they are growing around 1%. So you have in production growing, you have income growing, and spending growing. So keep that in mind. What about employment? Of course, the latest release, people said employment is slowing down. Yeah, this is the headline employment. But if you go into the details of employment, there are some numbers that are important leading indicators. And these are employment in construction, in residential building, and in truck transportation. As you can see, these indicators tend to lead a recession. They lead a recession here. They lead a recession here because they are very sensitive to interest rates. As interest rates rise, construction declines, and that tells you things are going to be the economy is going to perform poorly because of the importance of the construction business. So now instead, what do we have? Well, we have the trucking business, they're growing. We have the construction building employment growing. We have the residentials expanding. It is true, though, one point that these numbers are slowing down. As you can see, they are slowing down here. So there is a slowdown, but it's not the time to panic. The time to panic and be very defensive is when these numbers start declining, like here, and like here. So right now they're still growing at a slower pace is a warning sign. There is no question about that. What we have seen so far is what income is growing, sales are growing, production is growing, and employment is growing, slowing down, but it's still growing. These are the four major cornerstones to determine if there is a recession or not. And all four of them are still expanding. Now, let's look at an important input to the economy, and this is liquidity. I've been mentioning this for a while. This is the growth of the money supply. The money supply is basically the money that's being printed by the banks because they lend money to businesses. And as you can see, the blue line has been kept on rising quite steadily. So the growth of the money supply is growing, is expanding at a faster pace, which is now around 5%. So there is the impulse of increasing liquidity in the system that is going to help the system, is helping the system to grow. This is another very positive trend. And this is an important chart because it tells you how the markets are now reacting to what I just said. Yes, the economy is growing and the money supply is providing a tailwind to the growth. But this shows how commodities are reacting. This is lumber is growing because construction is still going on. If you look at housing starts and new home sales, copper and lumber are expanding and are growing. So they are responding to an increase to improving business activity. So this tells you, yes, in phase four, instead, what you want to see is all these prices actually to decline. And this is not happening. It will take a while for this to take hold. So we are still in phase four, but we don't see the trends, declining trends that says, okay, we are towards the end of phase four. And this is also crucial. You know, these are the commodities, the CRB index that I showed you in the previous slide. It's going up. And what happened to long-term interest rates? They are going up. They are both responding to increasing in liquidity and an economy that is not falling apart, as a lot of people are saying. Otherwise, you would not see these trends. So really, we are not even at the beginning of phase four that we can say interest rates are declining and commodities are declining. These data are not showing that. So we are still in a phase of when these prices will have to come down because they cannot keep on going up. People are being priced out of everything. So we have to be patient, I guess. That's what I'm trying to say. This is an important chart because it says what the stock market is doing relative to the business cycle. This is the stock market. This is the 200-day moving average. And below is our business cycle indicators. They peak every 3.5 years. They bottom every 3.5 years. It's interesting when they rise means the economy expanding at a faster rate, and the best investments are in cyclical stocks. When the business cycle indicators decline, it means the economy is slowing down and is a more defensive. You have to start thinking about a defensive strategy. The tricky part is the turning points, as they always is in a business cycle context. Here, the market bottomed in 2022, and it took a while for the business cycle indicators to create a base and then say, okay, we are ready to go. I think this is what they're beginning to tell us here in 2025. They declined sharply in the last 2 or 3 weeks. They're back to their bottom, and they're saying the economy is ready to go, but there is something else that has to happen. And I think we are going to go through this kind of ups and down volatility until there is a consolidation, and then eventually it's going to go up like in 23, and it's going to up probably 25 and 26 towards the end of 25. So the business cycle indicators are saying, let's be patient, let's wait what happens after this period of consolidation. And if everything is okay, in a couple of 2 or 3 months, the business cycle indicators should start going up, which is the time to invest aggressively. I think this is the story of this chart. So what are the indicators that we reviewed? What are they really saying? Well, it's saying income is growing after inflation at a nice pace. Consumer spending is okay. They are spending, slowing down maybe, but they're still growing. Employment, yes, the headline has been slowing down, headline number, and also some data, like construction employment, residential employment, construction employment. They are still rising at a slower pace, but it's still rising. So there is no whiff of recession that people are concerned about. There is industrial production is rising. So you have the basic 4 pillars of determining if there is a recession or not that are still expanding. That's the bottom line. Then we also said money supply, liquidity is improving, and this should be a nice tailwind behind the economy. We saw that this is reflected in rising commodities. Commodities have been rising. They rise not because there is a recession. They're rising because the economy is expanding. And finally, we saw the stock market. The stock market is probably, according to our business cycle indicators, is probably is pausing, regrouping for a few months until our business cycle indicators start rising, which means we have to go back into cyclical stocks. As you know, in our portfolio, we are heavily in cash, waiting for this period of adjustment to end. So everything is okay. We have to be patient. And after this period of pause, the stock market should start resuming its uptrend. Thank you very, very much for reviewing this video. I hope you found it informative and useful for your financial planning. I really do appreciate it. And again, if you want to dive in more detail, you know where to go. www.patreon.com/Peter Dag. Again, thank you very much for being here, and I hope to seeing you really, really soon. So long. Take care of yourself.